Hello, everybody. Welcome to our annual State of the Markets presentation. We are delighted to have all of you here today and look forward to sharing some important information with you. I'd like to draw your attention to these disclosures. Please take a few moments to review them and let me know at the end if you have any questions about those. Today, I'm going to focus on 4 key questions. How did stocks perform in 2022? What drove market performance in 2022? Where we are now, and what do major financial firms forecast for 2023? Let's begin with a look back at Wall Street analysts' initial predictions for the stock market's performance in 2022, how stocks actually performed in 2022, and some of the factors that drove that performance. The S&P 500 closed at 3,839.5 at the end of 2022, a decline of 19.44%, and well short of even the least optimistic expectations of most Wall Street analysts. Few, if any, major financial firms anticipated the March sharp drop from its historical high, which was posted on the first day of trading in 2022. It was a year of many surprises that forecasters simply, quite frankly, didn't anticipate. 2 prominent examples of this were the Russian invasion of Ukraine and the unprecedented series of sharp interest rate hikes undertaken by the Fed. As you may recall, in 2021, the Fed suggested that inflation was actually transitory. Markets managed to cut some of the worst losses with a modest fourth quarter rebound, but it was a difficult year for investors in both the stock and bond markets. Remember that the S&P 500 Composite Index is an unmanaged index that is generally considered representative of the U.S. stock market and to some extent of the global markets, because a good portion, about 35% of S&P 500 earnings are actually derived from international markets. But the index performance is not indicative of the past performance of any particular investment or any particular stock. Individuals cannot actually invest directly in an index. Past performance, as we've said so many times, does not guarantee future results. The return and principal value of stocks will fluctuate as market conditions change. Also, forecasts are based on assumptions and subject to revisions over time. I think that goes without saying, but it's important to understand that. Financial, economic, political, and regulatory issues may cause the actual results to differ widely from the expectations expressed in the initial forecasts. Let's talk about some of the factors that led to this. In the following slides, we'll discuss the factors that affected stocks over the year. As the chart shows, you see a nearly year-long decline in stocks as represented by the S&P 500 index until a modest recovery in the fourth quarter. There's a saying on Wall Street, don't fight the Fed, which has never been more true than in 2022. Higher interest rates led to lower stock valuations as the Fed turned to a monetary tightening policy. Let's review some of the overarching themes that drove stock performance last year without going through each of these dates. As you can see from our first data point in January, inflation was already reaching levels not seen in many years. Inflation would accelerate from here and peak at a 40-year plus record high in mid-year before moderating, though remaining at historically high levels. In response, the Fed undertook an extraordinary series of steps to combat inflation, including raising its federal funds rate from near zero to over 4% in under a year. Matters were made worse by Russia's invasion of Ukraine in February, which, in addition to the human suffering and loss of life it caused, created supply chain problems that led to higher food and fuel prices, which exacerbated the growing inflationary pressures that were evident before the invasion. Recession was a major worry for investors all year, as GDP growth, which was 6.9% in the fourth quarter of 2021, fell for 2 successive quarters before rebounding a bit in the third quarter. Stocks mounted a recovery in the fourth quarter as investors began to believe that peak inflation and the bulk of rate hikes were behind them, and that any recession in 2023 would not be as deep or prolonged as earlier feared. This late year rebound, however, stalled as recession concerns returned to the market in December. Corporate earnings are one of the factors that drive stock prices over the long term. As the chart shows, the earnings growth for the S&P 500 companies decelerated in 2022, though some analysts believe that they may trend higher in the second half of this year in 2023. Let's take a closer look. American businesses came roaring back from the pandemic, posting strong earnings growth in 2021 as consumers, helped by multiple stimulus payments, went on a spending spree as the economy reopened. The earnings growth rate also benefited from a favorable year-over-year comparative period. Earnings in 2020 were lower due to a national economic shutdown. Ironically, the 2022 earnings results were hurt by the comparisons to 2021's surge in earnings. But that wasn't the only reason for a slowing growth rate. Inflation squeezed profit margins while consumers were left with less discretionary income after paying for higher priced food and energy costs. We already touched upon some of the economic numbers, but let's spend a little time right now getting a broader view of the economy in 2022. Economic growth contracted in the year's first half, posting 2 consecutive quarters of negative gross GDP, or gross domestic product. The third quarter expansion came as a bit of a surprise to many economists, but it did show that the economy was proving resilient in the face of many challenges. An estimate of fourth quarter growth by the Atlanta Fed is now standing at around 2.8%. The labor market was a bit of an economic surprise in 2022 as well, with new jobs being added throughout the year, strong wage gains, and a steady unemployment rate. No one can overstate that inflation was the biggest economic issue last year, as the cost of nearly every consumer good and service rose. As you can see in the table, the inflation rate appears to moderate in the fourth quarter. A slowing economy coupled with high gas and food prices is a recipe for a pessimistic consumer. The table shows sentiment is quite low throughout the year. Its lowest level was in the second quarter when gas prices were near their highs for the year. Finally, higher interest rates sent mortgage rates significantly higher, making buying a home more expensive, or even refinancing or borrowing money to do remodels and things like that. This has reduced buyer interest and led to slowing home sales and slowing existing home sales. The housing measure in this chart is the sentiment index of home builders. So we've looked at some factors affecting market performance in 2022. Next, let's look at where we are now and examine the headwinds and tailwinds that could affect the direction of economic growth in financial markets in 2023. To create some context about where the economy stands today on various factors, let's start by examining where we stood in November 2020. I picked this month as a reference point since it represents a moment in which the nation was finally emerging from the pandemic, though not completely out of it, and Americans went to the polls to vote in national elections. As the indicators suggest, the outlook for the next 3 to 6 months was pretty mixed. The Federal Reserve's monetary policy was still accommodative, and interest rates sat at historical lows. Nevertheless, the economy appeared weak, hurt by consumer sentiment and the labor market. I want to draw your attention to inflation in the bottom left-hand corner. It still looked unthreatening at that time. Now let's fast forward to November 2021. By then, nearly every measure to gauge economic prospects looked pretty positive. There are no red indicators and only 3 yellow indicators. From monetary policy to consumer spending, the prospects for the economy for the next 3 to 6 months look pretty encouraging. Remember, at this time, heavy fiscal spending was stimulating the economy. Also, the Federal Reserve had not yet pivoted toward hiking interest rates, and COVID fears were actually starting to ease. Economic prospects, though, were about to change. As you can see, there are no green indicators a year later. This stands in sharp contrast to a year ago when we saw 17 green indicators. Last year, there were no red indicators. Today, there are 7. Monetary policy remains tight, inflation remains elevated, and higher interest rates are dragging down the housing market. In a nutshell, the near-term economic prospects appear tepid, and if a recession develops in the first half of 2023, the depth and duration of it may turn on whether the Fed eases up on rate hikes, the labor market continues to be resilient, and consumer spending holds firm. Let's delve deeper into one of those speedometers, the leading economic index, or the LEI. This index includes 10 components ranging from stock prices to manufacturing orders. This data may give a clearer view of where we are when examined together. As this chart shows, the outlook trended lower throughout 2022. While no economic model is flawless, the data appears to support some forecasting of a recession in the first half of 2023. From the leading economic indicators and economic speedometers we just reviewed, it's clear that 2023 economy may face some challenges. The first headwind facing the markets is inflation and rising bond yields. Both can hurt businesses. Inflation can make consumers less likely to spend on certain items, while higher bond yields increase business investment costs, reducing profit. Inflation remains above the Fed's target of 2%. The good news is inflation trended lower in the fourth quarter. If it continues to trend downward, it may give the Fed room to ease up on the size and pace of future interest rate hikes. That leads to our next potential market headwind, a recession. As the Fed tightened monetary policy, the drumbeat of recession fears increased. Finally, geopolitical tensions are a potential headwind. Headline examples include ongoing conflict between Ukraine and Russia and China's threat toward Taiwan. But it's worth remembering that it's often the geopolitical event that no one anticipated that surprises the markets. While the headwinds facing stocks are not to be underestimated, there are several potential tailwinds that may support the financial markets in 2023. In the final months of 2022, consumer price increases started trending lower. Falling inflation may boost consumer spending, which in turn could help corporate profits. Moderating inflation, as I just mentioned, may also give the Fed room to ease up or even pause on interest rate hikes in the year ahead. While inflation remains above the Fed's 2% target rate, fresh evidence of a downward trend may set the stage for a more dovish monetary policy. One result of higher interest rates in 2022 was a rally in the US dollar. A stronger US dollar hurts some multinational companies that generate part of their revenues overseas. Should the dollar weaken in 2023, it may help the bottom line for some companies. The cycle of higher interest rates may be closer to the end than the beginning. At least that's what we're hoping. This would be welcome news to the financial markets. Finally, some will keep watching China, the world's second largest economy. With China's exit from the zero COVID lockdown policy, a more open China may herald a return to greater reliability to the global supply chains and reinvigorated demand from Chinese consumers, which may provide a welcome boost to global economies. Before discussing the 2023 forecasts, let's examine this chart to see where stock prices trend against historical averages. The most common way to do this is to look at the PE, or price to earnings ratio, which measures what investors are willing to pay for a company's earnings. Looking at the dotted line in the middle, you can see that the PE for the last 25 years is on average 16.84. You can also see that the PE moves quite a bit, with a peak near 1999 and a trough in 2008. The chart shows that the PE was 15.15 on September 30th, 2022. Does that mean that stock prices will head lower or climb in the months ahead? That's really difficult to answer. If investors forecast lower earnings, then the E, or earnings part of the PE, will fall, causing the ratio to climb. Therefore, in order for the PE to stay at 15 times, then prices would have to fall. Of course, on the other hand, if expectations for earnings rise, then all things being equal, prices should rise in line. We've talked about what impacted markets over 2022 and what may impact markets in 2023. Now let's see what financial professionals have to say about where they think the market is headed in the context of a more detailed discussion of some of the possible headwinds and tailwinds we just finished reviewing. The share of gross domestic product, or GDP, that comes from consumer spending is just a shade under 70%, which makes the financial health of the American consumer essential to economic growth. One of the reasons for the strong corporate earnings in 2021 was an excess of savings. Consumer savings levels above the norm define what that excess is. These excess savings, which were built throughout the 2020 pandemic, were aided in large part by fiscal support or individual stimulus payments and reduced consumption, as the chart on the left indicates. Those savings started to draw down as Americans resumed spending with the economy reopening in 2021. However, as you can see from the chart on the right, these excess savings started to trend lower in Q3 2021. These excess savings may help provide some of the consumer spending that helps keep the economy from entering a recession, but that may only be the case if the labor market remains healthy and consumers stay confident about their financial prospects. Corporate earnings may be another driver of stock market performance in 2023. According to FactSet, a leading financial data and analytics firm, you can see that earnings are expected to trend slightly higher in 2023 after an up and down 2021 and the first half of 2022. Estimating quarterly earnings is difficult, but such estimates can help guide decisions about what price to pay for a stock. If earnings are healthy, it may support higher prices. Conversely, should earnings come in short of expectations, it may put downward pressure on stock prices. It's important to remember that forecasts or forward-looking statements are based on assumptions, subject to revisions without notice, and may even not materialize. And if we've learned anything during the past couple of years, the outlook for financial markets can change quickly. The course of stock prices in 2023 may be correlated to the path of interest rates in the year ahead. One tool traders look to understand where rates may be heading is the CME FedWatch tool, which analyzes the probabilities of future target rates as implied by the 30-day Fed funds futures pricing data. If we look at where the market thinks the Fed is going, we see that the market believes there's almost a 50% probability of the federal funds rate increasing from 4.75% to 5% by June end. Traders also price a 22% probability for a 25 basis point increase in the first 6 months of 2023. And there's a 26% probability attached to a 75 basis point increase over the time period. Keep in mind that the CME's group's tables changes on a daily basis. Probabilities are based on assumptions and are obviously subject to revisions. I think the important point on this slide to note is that, if you're looking at, a statistical probability, most likely we're going to be in that, 5% range, with the tilt towards higher rates having much lower probabilities. They're still there. I mean, I think the question about where that's going is a lively discussion, and we even saw that earlier this week when the Fed came out and said, "Hey, we might need to continue for a lot longer," which would mean over the course of the year seeing potentially higher rates. So that was a negative and caused some market pressure in the beginning of this week. Economic forecasters surveyed by the Philadelphia Fed in the fourth quarter updated their outlook for Q4 2022 and all of 2023. They reduced their expectations for GDP growth, lowering their earlier estimates in each of the next several quarters. They do see a rebound in economic growth in Q4 2022, however. Interestingly, their unemployment rate projections have stayed mostly unchanged through the first half of 2023, with a slight uptick toward year end. It would be reasonable to think that a sluggish economy might influence the unemployment rate, but that may not be the case. We'll discuss the possible reasons for why that split in the next slide. Despite a softening economy in 2022, the labor market was remarkably resilient. The series of charts we're looking at examines JOLTS data, JOLTS, or Job Openings and Labor Turnover Survey. JOLTS is a monthly government report that examines the state of the job market from the perspective of current job openings and turnover. Let's first look at the chart on the left, which indicates the ratio of the number of job openings to the number of unemployed workers. Coming out of the pandemic, the number of job openings rose as businesses looked to hire staff to meet demand. Now turn your eye to the upper right chart. That rise in JOLTS quits is what many called the Great Resignation. Following the pandemic, many people reevaluated their lives and jobs, leading many to quit for a new career or drop out of the workforce altogether. Finally, the lower right-hand chart shows the trend in JOLTS layoffs, which after a pandemic-related spike has trended lower. So what are the major financial firms forecasting for domestic stock prices in 2023? After a difficult year, forecasters are a bit downbeat about the prospects for 2023. As you can see, some firms are projecting a year-end close on S&P 500 not far from the market's 2022 close of 3,839. Indeed, note that the last year, Wall Street analysts missed the mark by a wide margin, which we looked at in the beginning. They were very bullish, but the actual came in much lower. My thought is that a recession and a rebound in corporate earnings will start by sometime in the second half. It is possible that the market can test the October lows, but in our view, this would represent a decent buying opportunity. I would say if you're looking at this chart where we stand, we're in the moderately positive camp for the S&P 500 performance, but you can see that the average is actually lower than where we are today. So it seems like as a consensus, everybody's expecting the market to slightly underperform. Just getting back to my former point, they missed the mark last year. It's probably a good probability they're going to miss the mark this year. And I still think that the second half is going to see as earnings revisions get more clear and they were able to see past some of the blips that have been caused by the lockdowns and the money supply increases. We get through that. I think earnings are going to become easier to forecast, and we'll be able to see that earnings growth starting in 2024 is going to be pretty positive. We've covered a lot of information, focusing most of our discussion on what drove the market and what we expect to move the market over a short period. As this chart shows, the performance of a hypothetical 60% equity and 40% bond portfolio was down through the first 3 quarters of last year, with negative returns for both stocks and bonds. As our chart starts in 1977, as you can see, it was the first time that both asset classes had losses. As I'd like to say, over the course of last year, there was nowhere to hide last year. Bonds typically act as a counterbalance to falling stock prices, and we just didn't get that, mainly because of the rapid rise in interest rates caused by the pretty stark shift in monetary policy by the Fed. In this illustration, stocks are represented by the S&P 500 Composite Index, which is an unmanaged index that is considered representative of the overall U.S. stock market. Bonds are represented by the Bloomberg Aggregate Bond Index. And you can see on that far right, which I believe is through the third quarter of 2022, that purple section on the down side of the 2022 is that the actual contribution of returns in that portfolio by bonds. So bonds actually contributed negative returns as well as stocks did. So what can you do in 2023 to move closer to your goals? Here are some action items for you to consider. If your personal life or your personal situation changes, please keep us in the loop. We want to hear about important family events, births, deaths, and changes in marital status and things like that. We also care about health issues, employment changes, and any financial developments that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us so we can help you pursue the kind of life that you most desire, and we can update your financial planning models that we've created for you. On top of specific adjustments in your financial lives, we also want to know how you feel about investment changes. These could be details like a risk tolerance shift or any market environment concerns that you might have. Finally, remember to review your state documents, beneficiary designations, and other paperwork to ensure that they're all up to date. A well-organized estate is one of the best gifts you can give to your family. We are here to discuss any financial questions or worries you may have. Our priority is and always will be to help you make informed choices and stay on track. Throughout 2023, we will focus on delivering the following. We'll keep you informed through regular communications. We will get regular emails, short videos from me, emails discussing hot trending topics in the markets, etc. There's going to be a lot of communication from us. Please keep on the lookout for those. We'll manage your investments according to your personalized strategy. We'll make adjustments to your strategy as necessary. And we're going to remain abreast of economic factors and make portfolio adjustments accordingly. So we've gone through a lot of information here, and I'm sure many of you still have lingering questions. Remember, if you're wondering something, there's probably a good chance someone else is too. So I'm going to unmute the forum here and allow any of you to ask a question. Just state your name and go ahead and fire away. I'm happy to answer any questions that you might have at this time. Are we unmute yet, Omi?
They can unmute themselves.
Okay, so you guys can unmute yourself as well if you have any questions.
So Larry here, I have a question.
Okay, Larry.
My concern is about the deficit spending impasse in the U.S. Congress, which I guess will come to a head in summer. And it seems like a certainty that that's going to drag on and it's probably going to get bad. I'm afraid that the stock market's going to take a significant hit as a result. Are there any sort of ideas from the experts as to what might happen then?
That's a very good question, Larry. And I know a lot of people are concerned about it. So historically what has happened, this is not our first rodeo when it comes to, debt ceiling fights and stuff like that. So we kind of do have some precedents. Typically what they'll do is they'll do like 30-day stopgap bills to continue the funding and raise the debt enough to continue the discussion. That's historically what we've seen. They can also potentially start shutting down certain non-essential government departments on the federal government to lower the cap. So generally what this ends up being is it's pretty bad for the challenging party. Last time, it's typically Republicans are challenging Democrats in this kind of scenario. And last time the Republicans did it, it didn't make them look too well in terms of how people perceive them. So I think they have political reasons to want to come to a compromise. So it is, I don't want to dismiss this as something that, most likely going to not happen, but I seriously doubt we're going to get to a point where we're not going to pay our bills. I don't think that that's a precipice that anybody's willing to jump over at this point. So it is a cause for concern. On the flip side, I think it's a good debate to be having about how we're spending and what we're spending things on. But it's I think if the past is any indication of the future, which we obviously can't guarantee future results, but the past is any indication, we're going to get through it. It'll probably be bumpy, but I don't think it's going to affect I think it's going to be more noise than like a driver of stock market returns.
Mm.
It's not to say that the government doesn't have an influence on the economy, but the stock market is really looking at earnings and the health of those earnings and the health of the economy. And I think the interest rate environment is definitely one that people are paying close attention to. I think the other one's more political showmanship, and I've said this many times before. Politics, they don't lead the economy in general.
Hmm.
And if they do, it's only when they pass large spending bills that take, years and years and years to implement. I'll point to the Inflation Reduction Act, which was a major infrastructure bill that is going to have some positive changes over time as the money gets fed into the economy to support infrastructure. But those things take years, and it's not something that I just don't I don't want to downplay it too much because I know it's a concern, but I think it's not the major driver that we should be concerned about. And if you talk about experts, I think if you set aside the noise about the different camps and what their different beliefs are, at the end of the day, it's about coming to a compromise. And I think more sober and reasonable heads are going to prevail on that. I think that right now is my take on it.
Mm. Thank you.
Mm-hmm.
Daniel,
Any other questions?
Phil Cohane here.
Hi, Phil.
In one of your slides, you showed that many of the financial institutions are somewhat pessimistic and negative about the stock market this year, with it coming in pretty much where it ended last year. You seem to be a bit more optimistic. I was wondering, what were some of your reasons for that optimism?
So my main reason is this. You may recall I sent out a video a little bit talking about the timing. This was probably, I don't know, maybe a couple months back now, but on the timing of when the market turns versus when earnings shift. So right now, so where we are in this cycle is, and I like to compare it to like the tide turning. It's hard to tell if the tide, especially with respect to corporate earnings, is the tide going in or is the tide going out? So there may still be a little bit of negative news on the earnings front, where earnings we're revising down earnings. Remember, earnings are really what drive pricing in the long run. So, but historically, what you're going to see is that the market itself, meaning the pricing of the market's a forward-looking pricing mechanism. They're going to start looking forward before we reach the trough of the earnings. And so my feeling is that we'll probably reach an earnings trough, maybe third or fourth quarter. And so that means sometime before then, it could be just a month or two, or it could be even, 4 or 5 months ahead of time. The market's going to start pricing in that rebound in earnings, and you're going to start seeing the market to go up based upon that. And so my feeling is that if there is a recession and we're seeing falling earnings, I'm still in the camp that it's going to be fairly mild, just because we have pretty strong there's the labor market's fairly strong, and demographics I don't think support a lot of people being unemployed. I just think that there's just already a shortage. Even as the economy is slowing, there's still a shortage of labor. So I think the economy seems pretty resilient. We're just, I think we're going to get beyond that earnings trough sometime later in the year, and typically the market's going to turn before that. And that's why I think we're going to probably be on the modestly positive side by the end of the year. Now, I guess my prediction is probably as good as anybody else's in Wall Street, but that's the basis for my reasoning. We've already seen a lot of cuts to earnings, but we're starting to see some mixed reviews on the earnings too. We saw some good numbers come out, like Airbnb came out and blew it out. Home Depot came out and blew out earnings. And they were all kind of like little, they were padding their future earnings estimates, but earnings seems to be holding up pretty well. So that's the basis for that. I don't, the other question is why is Wall Street so pessimistic? I mean, it's a good question. There's a lot of groupthink on Wall Street. That's for sure. I think right now that the consensus is that the Fed is going to overshoot on interest rate tightening. That's going to cause a more serious recession, which is going to cause earnings to be steeper. And I think that's their basis for that. I just don't think we're going to get there. That's again, it's me as an individual professional having the experience that I have. I just don't think it's going to be that severe. I could be wrong, but I just don't see the basis for it because the households are stronger. Indebtedness is a lot lower. This is not a 2008 scenario by a long shot. And yes, money supply grew rapidly and we have to drain some liquidity from the marketplace. We have to absorb those extra dollars. And that's kind of what we're going through now. But I just don't think it's going to be that severe. And that's the basis for why I think we're going to have the second half is going to look a lot better, certainly than the first half. So, and that's the basis for the moderately positive performance that I have.
Appreciate your insights.
Thank you. Any other questions? Last chance for questions. You can always, if you're shy and you don't want to ask a question now, you can always email us. So you can email questions, and I'm sure for those of you who are going to listen to the recording, feel free to reach out as well through email. Thanks so much for coming today, all of you who participated and asked questions. I can tell you that we're very passionate about understanding the markets, studying the markets, understanding portfolios and portfolio construction and positioning and how that influences your financial plans and how we customize those portfolios for your financial plans. So we enjoyed sharing the details today. Always feel free to contact us. You can also go on our website. There's links to schedule a meeting if you need to schedule a meeting as well. So thank you very much. And we will be in touch soon. Thank you.